Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, June 20th, and then we'll see how things look for Wednesday, June 21st. Happy first day of summer. If you really enjoy the summertime like I do, you're probably pretty pleased right now. I just want to say a very warm, heartfelt welcome to all new subscribers. It still just amazes me when I put something on YouTube and Rumble that people actually find some value in that, even though I think there's value there. Just to hear the feedback and have people subscribe to the channel is really a very humbling experience. So thank you very much and welcome. We had a little bit of a pullback on Tuesday. Not really a surprise. The market was really overextended. We had options expiration last Friday, kind of its own crazy day. The market was up strong last week, and to see things go back a little bit on Tuesday was not really a surprise. But now we have to keep a close eye on things to say, okay, is this just a pullback before we get set to go higher? Things are still showing a lot of improvement, but we need to evaluate the climate every day to see, are we shifting into more of a negative posture? Right now, no, that's not the case. But if we have more downward movement after this, we could switch over into that downward trend. And there's a lot of folks that are really expecting that. So we just want to be diligent in what's going on here and take it day by day and reevaluate things. Some notes before I get started. I do have a supplemental video that was posted a few weeks ago that deals with protection or hedging. Mainly, you're using put options to protect your initial investment or to lock in some gains. I'm also considering a new monthly video. I thought about doing a supplemental video that talks about, are we going to go into a recession or are we not? I'm kind of morphing that into the idea of maybe once a month putting out a video just on the economy. Some of you may have no interest in that. I will be covering these areas in the daily and weekly videos, but then I'll have a separate video that just takes the whole month, looks at it in review mainly. And then where are we standing economically as of right now? Does it look like we're going to go into a recession, or does it look like we're not going to go into a recession? I do have a PDF of all the slides and charts that you can download to follow along. I also have a private Facebook group that you're welcome to join. I did post a new poll for this week. And also, just to reiterate what I said previously, I'm really keeping a close eye on the YouTube comments. Just so you're aware, I also post these same videos on Rumble. All right, let's go back and talk about what happened. We did have a gap lower open. We went down to S1 right off the bat at 43.95. So yes, we fell below 4,400. Prices then quickly fell down to S2 at 43.81. We found support at 43.67. And at least by looking at this chart, the closest I could come to as to this being support is it was last Thursday's daily pivot. We seemed to hit that level and then started to bounce up off of that. It may have been support that came from a different market. As the day went on, we rebounded and got back above S2. We got up to S1 and then we closed below S1. We were down 0.47%. Now on Friday, we were down 0.37%. So we're still down less than 1% overall, but volume dropped to below average. Now that could be encouraging. As we've been going up over the last week or two, we've seen a real increase in volume. Now, last Friday was its own separate day since it was an options expiration day. But then to have a bit of a pullback after a nice run up and then to see volume drop off, right now we have to take that as positive. The technicals, they're still positive overall, and we're still dealing with an overbought situation. It is working off to a degree, and I'll show you some of those charts. What we're watching for now to see, are we going to see a shift from a more positive stance over to a negative stance? The markets continue to be fixated on inflation and interest rates. What are some comments that we can make? The S&P did fall back below 4,400. It was a relatively orderly decline that we saw both on Friday and on Tuesday. Again, we're under 1%, at least in the S&P 500. And it was more broad-based. There are a lot of stocks that have done well lately, and so people were just locking in some profits. It didn't seem to be all crazy or out of line. Discretionary was still up, and that's another growth area that we're keeping an eye on. It was up 0.8%. Home builders and home construction also advanced. We had some economic reports that came out that were really beneficial to them, and I'll show you those charts. On a short-term basis, we still have our shorter-term ADX study that we're using as kind of an experiment. That's still extreme. The CCI 14 fell off, but the CCI 20 is still on this overbought list. The stochastics are still extreme. The standard deviation, although it's coming down, is still kind of extreme. The short-term boom indicator, as well as the RSI based on 9 periods, and then the slope oscillator might be looking a little toppy, and I'll go through these charts. Intermediate term, we still have the Sean trend meter, the Arun, the PMO steady. All of our oscillators, we'll go through and look at those, but they're looking like they're at other points where we topped out before. Now, it doesn't mean they can't continue. We just want to keep an eye on that. The RSI 14, the 50-period boom indicator, the TTM squeeze is now starting to get extreme, and then we're still keeping an eye on the NASDAQ 100 BPI. The dollar was up, and interest rates were down on the day. We still have our yield curves that remain inverted. That hasn't changed. Sentiment is still extreme positive. It ticked down, but we're still above 75. We came in at 79 where we had been at 81. Our trend is still positive, but the green line continues to come down. The ADX is strengthening. It's still above its moving average, and both of them are above 20. So we are in a trending environment. Because we've had 2 down days now, I've switched our bias to negative, and our momentum is mixed. The economic reports that came out, we had total housing starts. This was really a surprise. They were up 21.7% on a month-over-month basis. And when you adjust that seasonally, it's 1.631 million. A lot more than the 1.4 million they had expected. Last time it came in at 1.34 million. Another thing that was strong were building permits. Now, both of these are leading indicators. So this could suggest that maybe things are looking a little better economically going forward. Where the permits came in up 5.2% month over month, seasonally adjusted on an annual basis, that's 1.491 million. More than the 1.425 million they had expected, and up from the 1.417 million that we saw last time. Looking at some Isabel net charts, here is the insider transaction ratio. These are legal insider transactions. There's a legal kind and then an illegal kind. If you ever saw the movie Wall Street, the first one, that's the illegal kind. This is where officers within the company buy or sell shares of the company that they work for, but then they have to report that. And it's coming up to kind of a high level, but now it's starting to drop off. When this goes up pretty high, that typically is a bearish sign. Also, we're looking at the risk appetite, where as we've been going up, folks are willing to take on more risk right now. Sentiment is also getting extreme. When we look at this indicator, we're above this standard deviation level right here, showing that maybe we've gone up a little too far too fast. People are getting too excited about what's happening. And then I'm not going to read all of this, but it just says at the top, a strong first half. Now, at the end of June, we'll be done with the first half of 2023. It usually means a strong second half. These are the statistics when you look at 1, 3, 6, and 12 months out. Then looking at the percent of those that say they're overweight in equities, it's still pretty small overall. The darker blue line is the U.S. stocks compared to global stocks, where they tend to be outperforming. Then we're looking at the cumulative percent of flows in equities over the last 2 years. It's leveled out a little bit right here. It has been going up, but as we've been hitting some difficult times, you see less money going into stocks. Then equity positioning is now clearly overweight. We were able to get above 0 with this, and so folks are tending to favor stocks over other investments or being in cash. And then what level of risk do you think you're currently taking in your investment? It's starting to go up just a little bit. People were getting pretty risk averse. Well, as we've been going up, they're willing to take on more risk. Looking at some real investment advice from their daily blog, this is kind of interesting. Here we have the big AI 7 with Apple, Microsoft, Google, Amazon, Tesla, Facebook, and NVIDIA. That's how they've been doing. Then on the bottom, this light blue line, this is the S&P 500, which has been hanging in there. And then the red line is the Russell 2000. These are the small caps, where they have been showing some improvement, but the big boys are really outperforming. Then this is kind of interesting. I won't go through this too much. If you watch any of my videos very much, you know that I'm not a real big Jim Cramer fan, who's on CNBC. There was also a spin-off movie from this that kind of took a parody of this show that George Clooney was in that you might find interesting. But this is in the year 2000. This is what Cramer said would happen, and then this is what happened after that. And it was on the Real Investment Advice blog, because we're seeing some parallels between what was happening during the dot-com boom and then bust with the whole AI thing that's potentially developing into a bubble. And so we have to really be careful of getting overcharged, thinking that things are just going to magically go up. We've been through the whole thing with crypto, and that's still, to a degree, is still existing. Now we're going to shift back over to the AI thing, and will eventually that bubble pop as well and end up hurting a lot of people in the process. All right, then they also go back to 1900. This is CAPE. This is the Shiller PE ratio that we look at. And we look at this every week and how, even though it's been coming down, it's still pretty high on a historical basis when compared to the S&P 500. The economic reports that came out, we had housing starts. The reason I bring up this chart is, look, it really shot up. This is the highest level it's been in quite a while. And that could be good for the economy. Here's another chart looking at that same thing. The blue line is housing starts, where they're starting to go back up. The building permits are also turning back up. And as I said, these tend to be leading indicators. So this could be positive for the economy. Then looking at housing starts, where it really shot up overall, we look at the correlation between the S&P and housing starts, and they have a pretty strong correlated relationship. Edward Ardeni had a few interesting things that he posted at his site, where this is what I cover in the intermarket analysis video, when we're looking forward for a PE ratio of the S&P 500. As of last Thursday, we're at 19. We're under that 20 level, but above 15. But then we have the price earnings growth ratio, and this is getting kind of high. It might be that folks are getting a little too optimistic, and I have another chart to show you of that. There's the short-term revenue growth, the short-term earnings growth, and then the long-term earnings growth, and this is how they've been performing. And this is one thing that's a little bit of a concern. When we look at IT, tech, the forward PE ratio is 27. Okay, so then it's kind of expensive on that front. And then I went to Investopedia.com to get some definitions of how can we use this PEG or PEG ratio. It says the price earnings to growth ratio is a valuation metric used for stocks. Okay, that's why we're talking about it. It goes beyond the PE ratio, and it considers expected earnings growth, not just current earnings. A ratio under 1 suggests that a stock is undervalued. Over 1 indicates that it's overvalued, and the PEG will vary based on the growth forecast and time frame considered. Well, if you look at this red line, we're at 2.5 right now, and they consider it over 1 being overvalued. The interesting thing about this is, look at the last time we got to this level. It was right around the whole .com boom and bust. Now, can the earnings come through and justify this and bring this overall ratio down? Yeah, that can happen. This is just something we want to be aware of. Looking at some interesting charts that I found, this kind of goes hand in hand with some of the charts that I talk about, especially in the weekly video. This is the trend channel going back to 2009. The conclusion that this person reached is a normal cycle advance, if that's what's brewing or happening, should carry the S&P to 5,400 to 5,600. The 200-day breadth momentum is over 50%, and it supports the bullish case. And then another thing put out by Jay Capel, it says, broken record time. Financial sector insiders continue to increase their pace of buying. Are they as crazy as the tech insiders were 8 months ago? Those are the people that started buying these stocks that are going up because of AI. The red dots equal the indicator crosses above 58, first time in 6 months. The financial sector, which has just been getting hammered and something that we keep a close eye on, it's seeing a lot of insider buying right now. That could give some really good support to the market as well. Now, looking at our charts and analysis, here's the 10-minute intraday chart. We gapped down to S1, we fell below S2. Then right about at the daily pivot for last Thursday, that's when we found support. We came up off of that. We never were able to really get much above S1, and then we ended up closing right down below S1. Here's the intraday chart where the futures were pretty much flat in the initial overnight session. Then we started to go more negative when things opened in Europe. Then we had the weakness in the day session. And then in the initial overnight session, we've been going back up just a little bit, but we're not continuing to fall off a cliff. When we look at large cap growth and value, growth did outperform slightly. The blue line is above the red line. On a closing basis, growth was down, but it was down less than value. The same thing with the mid caps and the same thing with the small caps. In the middle here, this is erroneous data, and I have the chart to replace that later on. When we look at growth to value for the SPY, this held up pretty well. We had a down day, but growth did outperform value overall. And so this means that there's some buying into weakness that we've been seeing. Looking at sentiment, still shows that there is not much fear when we look at the Ulcer Index. The VIX ticked up slightly on the line chart and the bar chart, but it's still very low. Since we are having a bit of a pullback right now, we're seeing an increase in the VIX of the VIX. And the equity put call ratio hasn't really moved all that much, but it continues to fall if we go up. It ticked up just slightly when we had a slight pullback. And then we're looking at this longer term where the 253 period simple moving average is rolling over and it continues to go down. The ratio between the VIX and the MOVE index is still showing that fear is not very high. And then when we look at the MOVE index by itself, we're seeing a real decrease in volatility. We're also seeing pretty low volatility with stocks. And the relationship it's not as strong as it usually is, but it's still fairly strong. The SKU index, after going up into this red area, we've now dropped back down. If we stay below that, then I won't show this chart. I just wanted to demonstrate how we've been coming down with that. We're also continuing to decrease based on this fear gauge, and this other fear gauge is pretty much flat, but continues to go down overall. Folks are still favoring being in a risk-on posture. Our advanced decline line. Okay, with the down day, we did see a bit of a decline based on price and volume, but we have been seeing a real improvement in this chart. New highs, new lows. Really dropped off with the down day. We could be rolling over a little bit with our 5 period, but our 10 period is flat to slightly increasing. And in the latter part of last week, we saw a big improvement with this chart. The advanced decline ratio, even though decline is still above 0, accumulation distribution is still above the moving average. We're seeing a little bit more weakness now with our cumulative advanced decline line. That's a bit of a concern where we had been seeing an improvement, and we also saw a bit of a decline with our regular NYSE advanced decline line. We're still above this trend line though, so that remains positive. When we look at common stock, again, we were seeing some improvement on this chart, even though we did turn down based on price and volume. Broad range, looking at the NYSE, we're still above the moving average. The same thing with the S&P. We're right at the moving average with the mid caps, and we've slightly dropped below the moving average with the small caps. Keeping an eye on our trend where the green line is now dropped back below 40. We are in an overall trend because the ADX is above the moving average. Shorter term though, even though the green line is coming down, the ADX itself is still extreme positive. Volume really dropped off because last Friday was such a huge day. Then some short-term looks. We just want to see if we continue to fall, will this previous high set in August 2022, will that provide some kind of support? We also have a pivot level right below current price. You can see on the bottom where volume dropped to below average. The 20-period exponential moving average is no longer extreme. We're turning down slightly with the 50 and 200. The CMB Composite Index, which had been extreme, is now dropping back down. The 20-period double and triple exponential moving average study, we're starting to come back down right now, but this may be providing some shorter-term support. The boom indicator, we're still a little bit extreme on the 20 period, the 50 period, and we're still showing some improvement with the 200 period. The Stochk RSI is no longer extreme. The Williams percent R just barely no longer extreme. The CCI 14 is now dropped from being extreme, but the CCI 20 is still extreme positive. The stochastics, even though they're turning down, we're still extreme in the short, intermediate, and long term. The force index did decline but remains positive. Intermediate term, we actually ticked up slightly with the balance of power, so that's positive. Looking at our 50-period double and triple exponential moving averages, we're still well above both of those. The go, no-go system, even though we declined, is still positive. The TTM squeeze, we're starting to get up to this black line here, which in the past has often marked an extreme positive reading. Longer term, just to give some more perspective, we're also getting up to this black line. We're coming down into the lower part of the third standard deviation, so we're not as extreme as we were, but we still are extreme positive. The PPO still remains positive across all time frames, even though we saw a little decline in the short term. The S&P 500 McClellan oscillator, after being extreme, has now dropped down. And the NYSE McClellan oscillator still above zero, but it is declining. We have another down day, and this could drop below zero and turn things a little bit more negative. The summation index based on price continues to advance, and we're still seeing it going up based on volume. When we look at the NYSE summation index, we are showing a little bit of improvement, but on a broader basis, it is lagging behind the bigger S&P 500. The Erin indicator hasn't changed all that much and is still extreme positive. Swenlin trading oscillator turned down slightly based on price and volume, but they both remain positive. The PMO, and this is what I mean, we're getting above this red line here. We might be getting a little too extreme with this reading, but we still continue to be positive based on price and volume. We've dropped down with the PMOs that are rising after being extreme, rolling over but still extreme with the buy signals, and going flat with the PMOs that are above zero. The Elder Impulse system remains neutral for the S&P 500. The parabolic SAR also still remains positive. The slope is also above this green line and starting to look a little bit extreme. The MACD, when you compare it to other times when it topped out, we're about at that level. Now, it doesn't have to stop here. We could still go up higher, but we just want to be aware that at other times, this did mark some kind of a top. When we look at all of our different oscillators, a lot of them are getting kind of extreme right now. So it's positive, and they aren't really changing all that much right now, and they still could go higher. The Sean trend meter has declined, but is still extreme. The BPI actually went up a little bit and then was down for the day, so it's red, but we're still showing some improvement with this chart. The NYSE BPI turned down just slightly, but we are above 50. The Chaikin money flow, even though it ticked up a little bit from Friday, it remains positive. The Chaikin oscillator, though, is still above zero, so it's positive, but it is declining. The ultimate oscillator turning down, but still positive. The vortex turning down, but still positive. Money flow turning down, but still positive. On balance volume turning down, but positive. RSI, we're starting to drop below this extreme positive reading, and RSI 9, we're also starting to drop below that. Looking at the study where we look at the percent of stocks inside the S&P 500 that are above their 200-day moving average, we are showing some improvement here, but we came down slightly. And when we look at the 50-period study, we also turned down, but we had been breaking out and showing some improvement. Here's a different look at that same chart, just color-coded to see if it looks better to you. The copy curve is rolling over a bit, but is still giving a buy signal, as is the Pring bottom fissure. Looking at our Fibonacci lines, if we really start to fall with this quadrant study, we'll be watching this 4170 level, but that's still quite a ways away from where we're at right now. If we start to come back down, we're looking at the August 2022 high as possible support. On a short-term basis, we're still above the 100% retracement level. If we fall, we'll be keeping an eye on the 4325 level. Our longer-term fib chart, also, if we start to fall, we'll be watching the 4313 level. And then longer term, if we even fall a little bit more, we'll be watching the 4214 level. Our different charts, a little bit of a negative candle in here with the Heiken Ashi. We're turning down with the Kegi, even though the black means it's positive, it is starting to point down. The Renko, though, still looks positive, and the three-line break remains positive. Looking at our different indexes, the equal weight had been showing some improvement, but continues to underperform the S&P. And that's also shown by this ratio, where the big stocks ended up doing a little bit better than the smaller stocks. Looking at our longer-term range of Dow theory, we are seeing some improvement with the transports, but they were down in Tuesday's session. We're also seeing a little bit of improvement here with the utilities, but they were weak in Tuesday's session. Even though the transports are showing some improvement, they continue to underperform the Dow. Then looking at our equal weight indexes, the discretionary is still in an overall uptrend. The staples are also in an uptrend, but when we take a ratio between the two, discretionary is outperforming the staples. The Dow, and this is kind of encouraging, we came down to this R1 level and that acted as support. The diamonds, though, remain neutral. The NASDAQ coming up to this R2 level didn't quite get there before turning back down. And then the Fibonacci chart for the NASDAQ, we're coming up to the 61.8% level. Could that be a significant level? Because we came almost up to that level and now we've been going back down. The new highs, new lows on the NASDAQ continued to drop off, but on the bottom, we went slightly negative now with this reading. The NASDAQ 100, this is what I posted on Twitter and on the Facebook page. We're coming back to the previous high in the NASDAQ 100, and I drew a line right here saying, is this going to cause a problem? Right now, yeah, the market's having a little bit of trouble with that. Can we fall back, regroup, and then break through that level? The Qs remain neutral for the Elder Impulse system, and we're starting to turn back down with the NASDAQ 100 BPI. It's not an official signal until we drop below this level, but we're getting very close. The Qs are still really outperforming the Dow. And then looking at the NASDAQ 100 retracement, where if we really start to fall, we'll be looking at the 61.8% retracement level. The small cap index, this is a little bit encouraging. Even though they were down, we're still holding support at this R2 level. But we still have overhead resistance. So the small caps are kind of boxed in right now. The small caps continue to underperform the S&P 500. And when we look at small cap growth versus small cap value, we're still in an overall uptrend, and they ticked up slightly in Tuesday's session. The mid-caps also still hanging on to support at this R2 level and gave us a recent golden cross. Mid-caps still remain neutral for the Elder Impulse system. And on a growth to value basis, though, we're still looking pretty strong with this. Then, because the home builders were up so strong, they really outperformed in the ratio, and that's showing our relationship falling off a little bit. That could be a positive divergence that we're seeing to see that the home builders are doing well when the S&P was weaker on the day. When it's the opposite of that, that's when we get a little bit concerned. The FANG index, which is still doing pretty well and was still up 0.5%, but we're keeping an eye on the all-time high, which is at about the 8,000 level. If we continue to go up, will this pose overhead resistance? Then looking at a broad market look at the S&P 1500 with shorter-term bonds, even though we ticked down, this is still holding up really well. Another broad market measure with further out bonds, even though it ticked down, is also still holding up. The tech sector turned down, but still holding up. Home construction didn't turn down, actually is breaking out. And again, you have to ask yourself the question, if we were getting ready for the economy to really slow down and possibly go into a recession, would this ratio really be outperforming bonds as much as they are? Probably not. And these are smart people that trade these things. Then we just want to keep an eye on growth versus value, where growth did hang in there pretty well in Tuesday's session. Keeping an eye on the financial sector. We were down 0.75%, still remain in a downtrend. The financials continue to underperform the S&P, but we're seeing a lot of insider buying here, which could be longer-term positive. Then we're also seeing this could be positive where longer-term support, so far the financial sector has come down to this level and we still remain above that. But when we look at the regional banking ETF and compare it to the financial sector, it still continues to underperform. Looking at bonds, we were down slightly based on yield and we were up slightly based on price. Then when we look at the value to growth ratio, which tends to go along with the 10-year treasury yield, they're still hanging in there and their correlation is pretty strong. Then when we look at the S&P to longer term bonds, we're seeing a little bit of improvement with the longer term relationship and more of an improvement with the shorter term relationship. Even though it did decline, we're still seeing a real spread between them. And folks are still tending to prefer riskier bonds over more conservative bonds. This is a concern when we're looking at cash and comparing it to further out bonds. This ratio had been going down. Now it's going back up. That means there's a lot of uncertainty right now about what might happen with interest rates. And then when we look at the S&P and compare it to bonds, even though we turned down slightly, the stock market is still anticipating a soft landing. But we're also keeping an eye on this. We're above the 3-month yield where we were at back in 2007, wondering, is this some kind of a warning sign? This is a newer chart based on a blog post that I read over the weekend by Tom Bowley. And he takes the 10-year yield for the U.S. and subtracts the German 10-year yield. You come up with this chart right here, and then you compare it to the U.S. dollar index, and there tends to be a really high correlation between the two. So I thought, okay, we'll start watching this just to get some insight as to what's happening with the dollar. Our long-term analysis, this is positive, where we're crossing above the red line with our special K. If you watch the weekly video, we're seeing the exact opposite of that. In the weekly chart, we're seeing the black line dropping down below the red line. So shorter term, we're turning positive, and longer term, we're turning negative. Okay, we're seeing a contradiction here. An update of our possible positive scenarios. The Qs are still doing strong compared to the S&P. Discretionary also had a good day. Large cap growth did outperform large cap value. With our growth to value ratios, we're going up with the large caps, a little bit of improvement with the mid caps, and pretty much sideways with the small caps. The S&P to utilities ratio continues to go up, and that could be positive for the S&P. Our longer look at the exponential moving average of the new highs minus the new lows continues to go up, and our indicator, even though it dropped, is still above zero. Then we look at the broad range of the 5-period moving average of the highs minus the lows. We are still positive. The 10-day average of the highs minus the lows in the S&P 500 is now starting to get extreme. That could be the negative to give us an overbought condition. But if we get up here and stay up here, that could just mean that there's really good momentum behind the market. When we look at growth versus value for the S&P 500, we are showing some weakness even though we're still in an overall uptrend. We want to see this really show some more improvement than it's showing right now. Then the 2-year Treasury yield, I dropped using this for a few days because the S&P and the 2-year yield are going in the same direction right now, so it's not really giving any support to the S&P 500. But we tick back up a little bit with our staples S&P 500 ratio, but overall we continue to decline, which could give really good support to the S&P. So what's our outlook for Wednesday? The Bank of England will be meeting on Wednesday to decide about interest rates. The technicals are still positive. We still have many overbought conditions. We still have some negative things and divergences that are happening in the background. Those are improving. Can we hang on to those improvements is what we're asking right now. We'll get the weekly MBA mortgage index that'll be coming out. And then on Wednesday, Fed Chair Powell will start his testimony that he gives twice a year. It'll be at 10 a.m. Eastern Time. He'll first appear before the House on Wednesday, and then he'll go before the Senate on Thursday. His opening statement is usually the same both days. They pay attention to it on the first day, kind of ignore it on the second day. Then when they start the Q&A, that's when the market tunes in to see if they can get any insight as to what he says. And then the list of geopolitical events, it's kind of about Fed speak right now, and then any concern about inflation and interest rates. Here's the economic calendar. So far, we just have the MBA Mortgage Applications Index coming out. And then here is the Fed Speak schedule for the entire week. Looking at June 21st with our Stock Traders Almanac statistics, we're neutral to negative with the Dow, neutral to positive with the S&P, and neutral to negative for the NASDAQ. We will be on the 14th trading day of the month. Overall, we see it pretty much flat with the green dashed line. But if you're looking at the NASDAQ, and tech stocks tend to hang in there fairly well until about the middle part of July. So our scenarios, not going with the down one yet unless you are completely convinced that this short-term pullback that we've seen on Friday and Tuesday is going to develop into a downtrend. Okay, go for it. But our charts are not saying that right now. They are still positive, even though we still have a lot of overbought indications. We have some negatives and some negative divergences. We are seeing some improvement, and so far that is holding up. But we're not going with the sideways trend, at least for right now, because both the ADX charts that we look at show that we're in a strong trend. The warning signs, the BPIs are diverging. The S&P is above 50 and showing some improvement. There are a lot of negative divergences and signs of weakness, but they're showing some improvement. Now we're wondering, can they hold up? The VIX is still showing that there's not a lot of fear. The cumulative new highs and new lows for the NASDAQ are still showing weakness. The 3-month yield is still above where it was at back in 2007. The small caps generated a recent death cross, but so far support is holding on that chart. Unfortunately, we also have resistance above current price. Earnings season continues, but it's on a case-by-case basis. Positive signs. We still have the seasonality and setup charts that I went through over the weekend. Those are still in the background. The new highs, new lows dropped off, but we saw some real good strength in that last week. The long-term special K indicator, it may be switching positive. Unfortunately, the weekly chart is switching negative. The equity put call ratio may also be dropping down and is turning more positive. We still have buy signals being generated by the Copic curve and the Pring bottom fisher. The S&P is still above that downtrend channel upper line. I haven't been showing that unless we really fall and get down closer to that line. We're still in a risk-on posture. Lower price levels, not only in the S&P, but on other indexes, may provide support if we start to fall. The S&P continues to outperform utilities. The NASDAQ and NASDAQ 100 are still hanging in there pretty strong. And the staples are underperforming the S&P, which can give some good support to the S&P. The mid-caps have just generated a recent golden cross. And small and mid-cap growth is still hanging in there, especially mid-cap growth right now. We'd like to see more in the S&P 500 growth, but at least we're seeing some strength in the small and especially the mid-caps. So our conclusion, the S&P, it's positive. We're still overbought. We still have a lot of these negative things to worry about. Can these positive things that have been improving, can that continue? On a short-term basis, we are positive, but still have a lot of overbought conditions showing. We're also positive, but overbought in the intermediate term. Long term, we still remain positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.